All right, welcome back, good people. The last time that we had an installation in PlayPosit, it was how to pay part 1. This is how to pay for expenses part 2. We're going to pick up where we left off at debit and credit cards. So again, debit cards are money that is just from your account, and credit cards would be money that you borrowed from a credit card company and you have to pay it back plus interest. And again, interest is a fee for borrowing money. Okay, so if you ask your friend, "Can I borrow $50?" and they're like, "Yeah, sure, fam, I got you." So they give you $50, and let's say that it takes you 3 months to pay them back because you've fallen on hard times and you're having some issues. You pay them back the $50, and you toss in like $12 because they were so nice to let you borrow that money. Okay. A bank is not quite as nice as your friend would be. All right, you have to pay them back, and that's a fee for their service. That's a service they're providing to you. They're giving you money, and in exchange, you give that back to them and you pay them a fee for their troubles. All right, so some things to consider when you pick out a credit card. You can't just be like, you know what, I like this Visa, let's just get it. Sometimes credit cards have some perks, okay, so they have some benefits to choosing one over another. So one thing to consider is what's called the APR, or the annual percentage rate. Now when I pay interest, when anyone pays interest, they want to pay a low amount because you cannot get interest back. All right, so if the credit union loans you $30,000 to buy a vehicle, you pay them back $30,000 and they say, we'll give you either a 4.5% interest rate or a 10% interest rate. That means you either pay them like maybe $1,500, or you pay them $3,000. There's a big difference there. So you got to make sure that when you're paying interest, you try to pay the least amount possible. Now, these words, annual percentage rate, APR, is the same thing as interest. So sometimes people will use them interchangeably. So please be mindful of that, especially when we approach our quizzes. All right, number 2 is rewards programs. So I personally like to travel a lot. So if I pick a credit card, I'm going to pick one that gives me airplane miles. So if I swipe my card enough and buy enough stuff and pay off my credit card, I might be able to fly to another country for free. Or I might be able to fly to California to go visit some family or go to Disneyland or whatever. You might have also seen something about cash back for groceries. So, or gas or clothing. So anytime you've ever gone to a clothing store, like if you go into American Eagle, or you go into Aeropostale, or you go into, like, I don't know, Journeys or whatever, you want to get some shoes, they might have a credit card where you can buy, or you can sign up for their credit card and they'll give you rewards, and they'll give you like, oh, do you want to sign up today for 20% off your purchase? No, always say no. Do not do that, because their interest rate, or their APR, is really high and you're going to pay a lot in interest. However, if you have a rewards program that gives you stuff in exchange, instead of a high interest rate, you might want to consider that. And the third one is the minimum payment. So what can I possibly pay per month at absolute minimum in order to pay off this card? So if you get a Visa credit card that has what's called a credit limit, so like that's as much as you can swipe. Let's say, for example, it's $5,000. All right. Let's say that you swipe it for $3,000. You can't just go 3 or 4 months without paying anything on it and then just like, I'm just going to pay it all off today. That's not how it works. You have to pay it in small increments so that Visa has at least some of their money back. Okay, so we'll skip this for now. All right, and then, can debt be a good thing? Most people say no, but we're going to tell you in civics and economics that debt can be a good thing, and we're going to say yes, that it can. All right, so you have 2 types of debt: good debt and bad debt. So some examples of good debt, and yes, there is a such thing as good debt. All right, so going into debt means you can't pay something off. It's going to take you a long time to pay it off. The first one is in education. So while it might take you forever to pay off your student loans, or you might be paying them for 5 years, 6 years, 10 years, 15, however long it takes you to pay them off, your education is going to get you a lot more job opportunities. Okay? So my best friend from high school, her dad is an anesthesiologist. So he is the guy who mixes the stuff and puts you to sleep before surgery. That is his job. All right, and he did not finish paying off his student loans until he was almost 45 years old. However, he drives a Maserati. Okay? So the amount of money that he made offset the cost of his education. Okay, so education can put you into good debt. And again, this does not have to be college because college is not for everyone. It can also be a trade school, you learning how to do a specific skill. All right, another one is a home because we talked about in how to spend money that a rent and a mortgage are two different things, and eventually you stop paying off a mortgage because you own that house. Okay, so a home can be a good set of debt because eventually you're going to pay it off and you own that house. Okay, bad debt would be a credit card. Okay, so credit cards are a necessary evil in our life, but they'll put you into $10,000 worth of debt, and then you got to pay back the $10,000 plus interest. Okay. Another thing that is not a good investment is a car. Okay, so if you are one of those people that you see a car go by and you're like, I like that car, and then you're gonna buy it, and then you buy the vehicle, and then like 3 years later you're like, I'm tired of this car. I want a newer version of this. You just wasted a lot of money getting a newer vehicle because the second that you drive the car off the lot and you sign all that paperwork in order to purchase that vehicle, the value of your car has gone down the second you drive it off the lot. And when you trade it back in, you are not going to be able to get as much money for it as you did when you drove it off the lot new. Okay? So you have gone into debt for something that is going to get older. Now, most cars do what's called depreciating in value. So they lose their value over time. However, some cars, if they're rare or if they're very old and there are a lot of people who want that particular car, the value of that vehicle will go up. So for example, like a lot of 1960s GM, Chevy stuff, like a 1967 Camaro it might be worth more money now than it was in 1967 because it's a rare vehicle and people want it. Okay, now if we're talking about a 2012 Camaro, probably not. Okay, because it's been out for 7 years, it's a little newer, and less people want that vehicle. Okay, so some cars can appreciate in value and increase in their worth over time, but most things depreciate and decrease. Gambling is another one. Y'all, if you think you are going to go sit at that blackjack table and you're going to get yourself rich real quick, not the truth, okay? You might have walked into that casino with 200, but you walked out of that casino in debt $700 to the casino because you thought you were too cool for school playing poker and you were not as good as you thought. Okay? So gambling is bad debt as well because there's no guarantee that you're going to make it back, even if you think you're super lucky. Okay? What does that say? All right, so anything that you can't make money back from is bad debt. All right, so why should you buy instead of renting? Well, because you buy it and you have it and it's yours eventually and you stop paying money. All right, if you rent, you're going to pay rent until the day that you die. All right, moving along. The greater the risk, the greater the return potential. So the word that I'm looking for in that blank there is potential. Just because you make a risky investment and decide to buy this beat up old junker car and you think you're going to flip it and sell it for $100,000 does not mean that is actually going to happen. There's the potential for what's called a return, or for you to get some money back and make some money off of it, but it's not guaranteed. All right, now the last thing we've got to talk about is your credit score. Now, y'all, as people who are not quite 18 yet and probably have not had any debt in your life and haven't proven to a bank that you can pay back any debt of any sort, your credit score is probably 0. That doesn't mean that you are terrible and you can't manage your money. That just means that you have not had an opportunity to prove that you can. Okay, so your score is 0 currently. So your credit score is a measure of how responsible you are at paying back debt and paying bills. Okay, your score is out of 850. It's not out of 1,000. Okay, 850 is your absolute maximum score. That's a perfect score. Okay, everybody starts with a score of 0. If you just pay an electric bill every single month for 2 years, your credit can come up to like 580s, 590s. If you're paying rent, if you're paying bills, and you're paying them on time or early in the full amount, you're going to end up building your credit. Okay? The average credit score is 678, 678. If I were you, I would put a star beside this because you're probably going to see this, I don't know, maybe on a quiz somewhere. Just saying. Okay, so a credit score 0 to 850 is how good you are at paying back debt. So if you sit in front of a person at the bank and you say, I need a loan for $100,000 so that I can buy a house, the first thing they're going to look at is your credit score. If your credit score is 515, they're probably not going to give you that $100,000. However, if your credit score is like 780, you've done really good, you pay your bills on time, you pay your credit card off on time, you can handle your student loans, you can handle a car payment, you can handle you can handle your credit card payments, then they're probably more likely to give you the loan. So a bank is going to look at you and be like, how likely am I to get my money back? If the answer is not very likely, family not giving you that money. Okay, so some credit ranges and some credit parts. Excellent credit is 780 and above. Okay, so average credit is 680 to 719. Most people are right here on the average and below average line, so 678. Poor credit is down here in 580. Usually has just a little bit of credit issues. When you ask someone to loan you money, they're going to say no. Okay, so here's some things that affect your credit. So your payment history, are you paying bills on time? Are you not? How much do you owe? Do you owe $15,000? Do you owe $3,000? The more money you owe, the less likely people are to give you a loan because you already owe a bunch of money to a bunch of other people. Now, this part is a little tricky for people who are younger. The length of your credit history accounts for 15% of your credit score. If you are 20 years old, just coming out the gate, and all you have is a credit card, that is not going to be good for you because you've only been paying off your credit card debt for a year or so. Now, my mom, because she is 65 years old and has a long credit history, has been paying off debt since she was 18, she's going to have a better score than I am. Not because she's better at paying than me, but because she's been doing it longer. Okay, new credit is 10%. So, did you open a new account? Did you try and show the bank that you are good at managing debt? And this last one is types of credit. So, is it a car? Is it a house? Do you have 17 credit cards? What type of credit are you using? Okay, so again, you need to have a good credit score. Pay those bills on time. All right, get yourself a tiny little credit card and pay it off every month, and you're good to go. At least for a while. So how do you build credit? You pay off your daggone debt. Do not leave debt hanging over your head. That is not helpful for anyone. Open some small credit accounts. Get yourself a credit card that has what's called a credit limit, which is how much you can spend of someone else's money. That is like, I would say probably 10% of your income. So like, let's say for example you make $50,000 a year. Do not open a credit card that has more than $5,000 on it because that's only 10% of what you make. So you can use 10% of your check every month to pay off that credit card. All right, make your payments on time. Stop paying your rent 17 days late. Okay, stop paying your rent 7 days late. Turn in your daggone utilities bill, pay your insurance. If you think you're going to be forgetful and you're not going to be able to pay bills on time, have it auto-drafted out of your account so you don't have to remember. Okay, you've got to make your payments on time if you want your credit score to go up. All right, or take out a loan. Ask the bank for a loan, do some work on your house. Ask the bank for a loan, do some work on your car. Get yourself some nice tinted windows, jack your car up if that's what you want to do. Something. Okay, take out a loan for something or something or other. Go to trade school. Go do something. But you have to take out a loan if you want to build credit because you are proving to a bank that you can handle amounts of debt. Start small and then build. All right. What if you don't make payments on your credit card? Stressful times. Okay. Now, these are two different ways to make payments or to not make payments. Bankruptcy is owing more money, period, than you are able to repay. Not on one specific thing, but you just owe more money than you are physically able to repay in a month. That's what's called bankruptcy. Okay. And if that happens to you, you have to do what's called filing for bankruptcy. And there is some governmental assistance to help you out. Now, foreclosure means you can pay some of your bills, but you cannot pay your mortgage. So you decided that you were going to buy a house, and you bit off a little more than you could chew, and you took out a loan for too much money, and now you can't pay it back. And there's no way you're going to be able to pay back this house. Okay? So if you get a loan from a bank, the bank owns your house until you pay them back. All right. So the bank will do what's called foreclosing on a house if you can't pay your mortgage. All right. So United States bankruptcies hit an all-time high at the at the end of 2006, early 2007, and then bankruptcies kind of skyrocketed up here towards 2006 and 2007. And this point with all these bankruptcies is what's called the recession. Okay, then it kind of not skyrocketed, kind of like plummeted back down to the earth, and not quite as many bankruptcies were filed because, all of them are over here filing it. All right, and then it spiked up again in 2012. So this is kind of how our economy flows. People do good for a while, people don't do good for a while. So it just depends. Okay, so businesses filing bankruptcy, if you see this green line at the bottom, is very low. People or consumers filing bankruptcy is much higher. So pay your bills, children, and don't buy a house you can't afford. All right. And that has been How to Pay Part 2.